Hey there, everyone. Welcome to my weekly show on Stockcharts TV. My name's Dave Keller. I'm the founder of Market Misbehavior and the president and chief strategist at Sierra Alpha Research. I'm so happy you're joining me here on my weekly show on Stockcharts TV, where I break down key market theme, key technical indicators, key approaches, key charts that I'm watching, basically trying to give you a little bit of an inside behind-the-scenes look at how we're trying to make sense of these markets during uncertain and volatile times. We're recording this here on Monday, January 27th, and if you don't know what, or if you didn't know what DeepSeek is, you probably do by now, because that is single-handedly causing the tech sector to drop aggressively here on Monday, for the NASDAQ 100 to lag big time behind the other major U.S. equity averages. And I think certainly for a lot of investors, bringing the AI-fueled frenzy that dominated investor psychology in 2024, certainly bringing that into question. The short version, if you're not familiar with this, was a Chinese AI operation called DeepSeek, now one of the most popular apps on the Apple Store, and essentially, allegedly, is pretty much competitive with major AI models built here in the U.S. It's completely open source, supposedly required a lot less technology and computing power, and not a lot of help, if any help, for many of the big U.S. technology companies, particularly chip manufacturers like NVIDIA. So the whole bull market for mega cap growth in a lot of ways has been driven by optimism for AI, the computing power that is needed, the leading role of the U.S. and U.S. companies in this global AI frenzy. All of a sudden, this puts a big question mark on that whole thesis. Now, at the end of the day, what's great about technical analysis and charting is that it helps us not get nervous about what could happen, but focus on what actually is happening. I wrote an article on Friday for Stockcharts with this title, Semiconductors Have More to Prove Before Breakout is Believed. And we talked about, the conditions going into the weekend with, while in some ways it felt like a very strong technical profile with a break above resistance, also some of the concerning developments, particularly the fact that we had a big bearish engulfing pattern on the SMH and other semiconductor stocks on Friday, certainly suggested short-term weakness. Now, I would not have guessed this week this quickly, in terms of the aggressive move to the downside for semiconductors, but what I wanted to do is follow up on that article from Friday. I'll put a link in there. I'd encourage you to review that article as well, which has charts and a lot more comments in there. But what we're going to do is just recap some of the key themes of that article and focus on what's next. Now that we've had the sell-off here so far on Monday, what does that mean for semiconductors and indeed for the larger markets as a whole? So here's kind of the initial look that we had at the semiconductor ETF, and we're using the VanEck Semiconductor ETF, which is ticker SMH. There's another ETF pretty similar, I would argue, in terms of liquidity and fees and general structure, called the SOX, SOXX. That is modeled after a very popular index called the SOX Index, which is the Philadelphia Semiconductor Index, widely followed in the institutional community. The SMH has become very popular with retail investors. That's what I usually use sort of as a proxy for the semiconductor space. It's worth noting before we get too deep into the chart of the SMH, while it feels like semiconductors are all moving together, there is quite a bit of diversity, and I would think of it, this is probably oversimplifying it, but I would think of it in three general buckets. Number one bucket would be sort of the mega cap leadership roles, NVIDIA, AMD, right? The big, huge mega cap growth stocks, sort of the Magnificent Seven level of market cap, really dominating in terms of the size of the companies and the weights certainly in some ETFs, particularly the NASDAQ 100, right, where something like NVIDIA is a top weight. But those mega cap names have a particular trajectory, and I would argue fueled in a lot of ways by NVIDIA's leading role, or up until today, perceived leading role in AI and the computing power that's required, and the fact that their chips are so vital to sort of answering these AI questions in an area of the market that's moving obviously quite rapidly. The second bucket of stocks, I would say, would be, and this is probably a one-stock thing, Intel. Intel is a very different business model than something like NVIDIA or AMD. Really trades more like a mature growth company, right? Sort of a more stable company. You can see from the chart, it looks very different from a lot of semiconductors, because while NVIDIA spent 2024 outperforming and growing even larger, Intel spent pretty much the entirety of 2024 going down, and a big gap lower in August sort of eventually found support. Potentially, we're making a another retest of support around $19 a share and change, but overall certainly a weaker trajectory for the last 12 months for sure. Then that third bucket would be kind of the other semiconductors, things like Monolithic power systems and other names that are semiconductors that aren't those big names that you probably know. There are a bunch of other smaller semiconductor names. Now, at times in 2024, something like MPWR, an incredibly strong chart, and you can see really through August, September, position of strength, making higher lows all along that way. Something like MPWR changed quite a bit going into really in the midst of the fourth quarter, kind of October into November. You can see a couple gaps lower. One of those was around earnings there at the end of October, and overall really has tried to regain its footing. And I would say that was what, one of the things that certainly felt like semiconductors were in a nice recovery phase was the fact that MPWR stopped going down, and not just stopped going down, but actually started to go up, right? So we're making lower lows. We stop making lower lows. We start making a higher swing high. So still below the 200-day moving average, so still not a great chart, but starting to improve a little bit. Of course, today, MPWR and pretty much all other semiconductors getting beaten down pretty good on this news related to the Chinese AI app, which has all of a sudden become front and center for a lot of investors. So that is just a way of saying that semiconductors are a little more diverse than just looking at the SMH might imply, and it's probably oversimplifying it, but I think of it in three buckets. You've got the mega cap growth names like NVIDIA and AMD. You have Intel, which is just kind of a different different product. Again, it's more of a legacy chips that are used in a lot of have been used in a lot of devices, and then all the other semiconductors I'm kind of grouping together. There's some more subtleties there, but I think that's a good way to think about it. So, what happened to the SMH? So on Friday, what we talked about was the fact that we had broken above resistance, and I had two alerts set on Stockcharts to track. And again, I think the alert functionality on Stockcharts is the best I've seen. It's fantastic and allows you to set alerts on very simple things like SMH breaking above 260, which is why my phone dinged last week when we had that gap and the push above 260, because I had seen that was a level of resistance. So when I'm drawing a trend line like this on the chart, I recognize an established level of resistance. I draw the line, then I immediately set an alert because I want to know. I don't want to have to look at the chart of SMH every day. I want the platform to tell me when SMH breaks above 260. And what's really cool about the alert functionality on Stockcharts is that they're very easy to set up. So here's the price alert setup. You basically set the symbol. It'll bring up a little preview chart so you can get a sense. And this is really helpful just for identifying the key levels. So the alert I set before was tell me when it breaks above 260. I set a comment in there. And then I like to select all three of these. Email is helpful because I have an email rule in my Gmail account that puts everything in a folder, all my Stockcharts alerts, so I can go back and review them later. It text messages my phone, so I can get an alert when that's popped up wherever I'm at. If I'm not at my desk, I'm aware of it. And then the site notification puts this banner right at the top of the screen. If you have all of these set up, there is literally, I challenge you to not catch those alerts unless you're sitting in your bed reading a book with no devices around you, which I argue most of us don't do anymore, probably, unfortunately. Checking all of these is going to make sure that you're aware of it. So I did have that alert set. I also had an alert for when it broke below 240, which is what actually triggered for me earlier today and inspired me to do this video to dig in a little more. So we talked about the break above 260 as a meaningful move, and I would say on Thursday of last week we actually continued higher. We had some upside follow through. Now one of the problems we talked about, which I think is still valid, is even though we'd broken above 260, which I thought was bullish, I'm also looking at this gap. When I see gaps on the charts, I think of them as support and resistance ranges. I like to draw these rectangles, particularly on stocks and ETFs that I own. Anytime I see a gap, I immediately put a rectangle highlighting the gap range, and I just keep pushing that forward to the current day, because at any point I want to know where we're at relative to some of those key gaps. And eventually, probably a gap like this is no longer meaningful, right? Like this gap back here from March, I don't know if I can't imagine that has any meaning in January of 2025, 10 months ago and kind of in the middle of the move. But in the short term, I certainly pay attention to gaps like that because I know that this gap higher in February, if and when we rotate back lower, I'm probably going to assume there's support to be found there, which it did in April. So I often sort of reflect on those gaps, highlight them on the chart with a rectangle, and that's what I had saved here months ago from that July peak. So as we pushed higher, I'm immediately thinking I like the break above 260. However, we are getting to a resistance range. We're getting to that gap, and that gap would now be filled, and we would really have to have some significant upside momentum beyond what we've seen so far to get above that gap range and then continue to power above $280 and make a new all-time high for semiconductors. That seemed like a tall order given the run that we'd had so far over the last week and a half. Now, the other thing that we noted, which I'll highlight here, is the fact that we had what's called a bearish engulfing pattern. This is a candle pattern where we have a big up day and a big down day, right? And so the day two of the two candle pattern, day two, the open to close range, which is basically the body of the candle, day two engulfs the range of day one's real body. So you have an uptrend, you have an up day, you have a down day, open higher than yesterday's close lower than yesterday's open. So one day looks really good. We have a higher open. That's encouraging. But by the close of day two, we're all the way back below the previous day's open. So the short-term sentiment shifted quite a bit. What's interesting about semiconductors in particular, this is not actually that rare. It's actually quite common for semiconductors in particular to show bearish engulfing patterns at major peaks. I'll show that chart and a couple more to sort of round out this discussion, then focus on what we see going forward. But I do want to let you know really quickly, we have a webcast coming up later this week on Wednesday, January 29th. We will be doing a webcast called The Morning Coffee Routine Strategies for Success. This will be a free webcast. We'll be doing it using our StreamYard platform that we like to use for our market recap show. It'll be at 1 o'clock Eastern, 10 a.m. Pacific on a Wednesday, January 29th. It is free to attend. I would encourage you to go to marketmisbehavior.com/morning or just scan the QR code that you see on your screen. What we're going to talk about is literally the set of charts that I look at every first thing every morning. I literally get a cup of coffee, I open up the laptop, and these are the charts that I look at. And I will explain to you why I look at certain charts in a certain order. I will challenge you to think about how you spend your morning coffee routine. And I bet there are some things we can tweak for you, some things that may, give you some room for improvement. And if we can upgrade how you spend your morning coffee routine, hopefully that leads you to more mindful investing practices through the remainder of the day and more consistent decisions, more consistent results. Again, free event coming up on Wednesday the 29th, 1 p.m. Eastern. Go to marketmisbehavior.com/morning to sign up for that free event. All right, so here's the chart of semiconductors that we were looking at. In particular, we're talking about the bearish engulfing pattern. This is a two-candle pattern, and again, I would encourage you, if you don't know what I'm talking about, here on Stockcharts, go to help or search, look for bearish engulfing pattern. There's great articles, free resources in the chart school portion of Stockcharts to help you understand those. I will tell you, I've just talked to some people that have recently passed their CMT exams, completed all 3 levels. I remember a couple of years ago when I was studying for my own CMT exams, and I don't want to date myself too bad, but it was still pencil and paper for parts of it. So that tells you how long ago that was. But as I was studying for the exams, I used the chart school portion of Stockcharts to help understand candle patterns. And I'd read books by Steve Nissen and John Murphy to learn them, but the resources, the free resources on Stockcharts were a great way to supplement that material that I was getting from the CMT program. Help me to think about new examples and get a different voice, a different perspective on the indicators and how to use them. And I passed the exams all the first time, and I would definitely credit the time I spent with the chart school portion of Stockcharts as part of that success. So thank you again to Stockcharts for helping me pass the CMT exam. So here's the bearish engulfing patterns that we talked about. Up day on Thursday, big down day on Friday, day 2, the range open to close engulfs day 1. You see that back here at the beginning of January. We gapped higher, had a big, probably call that a shooting star candle, but the second day makes it a 2-bar pattern called the bearish engulfing pattern. And you will actually see that in a lot of other places. I'm now bringing in a lot more data. We're looking about the last year. I've highlighted in red, those last two that we talked about were just these two right here. But look how at a lot of every major peak, not all of them, not everyone, right? There are plenty of peaks that did not have this pattern, but when this pattern pops up, and again, it's only valid during an uptrend, right? So the market's going higher, I'm immediately looking for bearish candle patterns like the bearish engulfing pattern. And when I saw this on Friday, I'm like, oh my gosh, how many times have we seen this in the last year? And I actually looked it up. 1, 2, 3, 4, 5, 6, 7. Last Friday meant the 8th time in the last 12 months that we had that bearish engulfing pattern. 100% of the time, we've had at least some sort of pullback. We've made a new swing low before we made a new high. In some cases, they've been significant drawdowns like we saw in July into the August low. Other times, brief pullbacks, but helpful, right, to understand the short-term sentiment has shifted. So while that bearish engulfing pattern on Friday does not necessarily suggest the severity of the move that we saw here today on Monday so far, it does certainly tell you that the path of least resistance is lower. This is the type of pattern that I love to watch during the trading day, because earlier in the day, you could see that a bearish engulfing pattern was developing. Going into the close, that's the kind of time when I would probably start unwinding at least a short-term position, because I can see that the likely move is lower. So even if I want to be long semiconductors, what that pattern tells me is over the next 1 to 3 bars, we're probably going to come down a bit. And so I probably can enter back in at a lower level and buy a good group at a discount, right? So that short-term pattern, while I'm more of a medium-term and long-term investor, the short-term candle patterns can be so valuable. So with that in mind, let's put all of these things that we just talked about into one chart and then start to talk about what might be next. So we've combined all the different kind of components that we talked about on the previous charts. Number one, I switched from a bar chart, which is my kind of normal default look, to a candle chart. And I've often gotten questions on my market recap show called Chart This. Dave, why don't you use candle patterns instead of bar patterns, or candle charts instead of bar charts? And the answer is, I just tend to be thinking a little more long term. And if you're bringing in 2 years of daily data, the bar chart and candle charts actually look so similar, because the pixels, there's only so much data you can put, when you're looking at a pixel at a time. And so, they kind of just blend together. So bar charts are fine, because I'm less concerned about short-term movements. I'm trying to understand more of a little medium-term and long-term trajectories. But I will tell you that one of my favorite ACP views that I use on stock charts actually combines candle charts along with other timeframes, and that's specifically so that I can reflect on the short-term sentiment and use that as more of a timing tool, right? Is today the right day to be pulling the trigger on this monthly or weekly theme that I'm seeing start to emerge? So here we are, going back to the beginning of our discussion, we have that resistance line at 260, which again on Thursday, Friday, we broke above. We can also see the gap really highlighting how that action in the latter half of last week was really just playing around with that range, that gap range from mid-July. We can see the gap lower, of course, taking us back below 260, suggesting that was indeed a failed breakout. But most concerningly, I would say today's drop for now is pushing us below the 200-day moving average, which is actually right where we opened. We opened almost exactly at the 200-day moving average. We did briefly trade higher, but then a bunch of additional selling, pushing us at the moment all the way down below 235. And that push below 235 is also concerning, because I would argue that October, November, December, much of January has been range bound, right? It's been a sideways trend. Remember, markets can go one of 3 directions at any time. It can be in an uptrend, a downtrend, or a sideways trend. And Jesse Livermore famously said there's time to go long, time to go short, and time to go fishing. When the market's going sideways, that's kind of the Jesse Livermore time to go fishing time, right? It's time to sit on your hands and just wait for further evidence to be presented, to wait for an initiation of a new uptrend. It certainly seemed mid last week like that new uptrend was going to be higher, but we failed to follow through above gap resistance. We're now gapping lower, and I would argue we've now blown out the lower end of this range. Look at the support levels from early October. That's why I initiated this horizontal line. You can see lows in mid-November, the hammer candle in late November. This isn't quite a bullish engulfing pattern. Do you know what candle pattern this is, by the way? If you are trying to learn these patterns. That's actually called a bullish piercing line. That's where you have a 2-candle pattern, a down day followed by an up day, lower open. The close doesn't quite get above the previous open, which would actually make it a bullish engulfing pattern. It's called a bullish piercing line if we close at least halfway through that first candle's real body. So that is a short-term reversal candle at the support level. So I love when a candle pattern occurs right at a major support. That's a further validation that we're probably going to get a bounce there. Indeed, we did. We rotated back to test resistance at 260. Here in early January, we didn't make it down to this support level, but we did bounce off of the 200-day moving average. So today, we've broken the 200-day as well as the previous swing low and also that major low that's held very, very well for the last 3 to 4 months. Now, what happens next, I would say 2 things. Number one, do we get follow through? Investors are dealing with a lot of negativity because of the new technology suddenly coming out of China. Big question mark all of a sudden on the dominance of U.S. companies driving this AI revolution. And again, just questioning how much money, billions and billions of dollars, companies like NVIDIA and Apple and Meta and others are spending on AI. Maybe bringing that into question in terms of how much money they're feeling like they need to spend versus an open source product that seems to be pretty competitive already. So having said that, investors are dealing with a lot of that negativity, obviously revaluing semiconductors much lower very suddenly. That's $30 down. That's about a 10-15% drop overnight. That has some significance. The question is what happens tomorrow, right? Once we sort of digest, have a chance to sleep on however the day finishes, what's next, right? And so I think Tuesday's session is going to be vital. Looking for bullish candle patterns. Do we get some sort of bullish engulfing pattern or bullish piercing line that would indicate investors are now buying short-term weakness and saying, all right, that was down a lot, but too much, right? I mean, there's still plenty of upside for semiconductors. Maybe we buy some here, and that could cause this chart to go upside very quickly. The other option, of course, would be downside follow-through. Let's say if we get additional selling, which says this is just the beginning. We're down 10, 15%. Nope, we need to be down 20, 30% to really bring these stocks back to a reasonable valuation based on this new information that's come out. If that happens and we get downside follow-through, then you need to start thinking about downside targets. Because now that we've broken the most recent major lows, now that we've broken the 200-day, I would be looking down to the April and August lows, which are down at $200 a share. That would be down from 280 to 200. That's what, 25 to 30%-ish, depending on where we pick the top and what values we use. But that's a pretty significant drop. That would be a major correction for semiconductors, and would match really the sell-off that we saw from the July peak to the August peak. That was about a 2.5-week experience from 280 down to 200 the last time. Maybe we have another one of those similar moves bringing us back to a well-established support level. Along the way here, I would very much be looking at momentum. Right now, the RSI just below 40. If we hold around a level of 40, that can be an encouraging sign. But if we break further down, if we get down toward oversold levels, that may suggest that we have much further downside to be had. That's my take on semiconductors, really completing this work that we did end of last week. Again, I would encourage you to read the article that we put out, but then also use some of the new information we've learned here on Monday from a technical perspective. What does that do to the charts? The real goal of this video is just to reinforce the benefits of looking at candle patterns. Even if you're a medium-term or long-term investor, and certainly if you're a swing trader or a day trader, candle patterns should be an important, if not vital part of your technical toolkit. And I think Stockcharts does a brilliant job of allowing you to use candle charts in a lot of different places. By the way, don't forget that as a Stockcharts member, you can set alerts based on price levels. You can set alerts based on candle patterns emerging. You can scan for bullish engulfing patterns. Did you know that? Make sure you go to the charts and tools section of the Stockcharts website to check out all of those fantastic features. Let Stockcharts do some of the heavy lifting for you. And I wish you very, very good luck and happy investing. That's it for now. For Market Misbehavior, I'm Dave Keller. Have a fantastic week. And remember, it's always a good time to own good charts.